by what we know. What you know, what you don't know. The accumulation of knowledge or the lack of knowledge affects your dreams, affects your future, affects your income, affects your bank account, affects your associations, affects everything. It's great to hear Charlie talk about reading books. So important. All the speakers here have mentioned, right? You've got to really be a student, study, so you can learn how to make wise decisions that'll give you the best chance to build for the future. Okay, here's what's next. We're affected by results. Whatever your current economic results, whatever projects you've launched, the results up until now, that affects you. The results you've had in the past, up until now, that's affected you. Now here's number 5. We're affected by our dreams. Our dreams meaning our view of the future for ourselves. Now here's a note to make. It's important to make sure that the greatest pull on your life is the pull of the future. Now we talked yesterday about reviewing the past, which is fine, but we're not to live in the past. Some people let the past pull them back. The past can be like gravity if you let it to pull you back, not just to think about it to get advice from mistakes to carry on for the future. But some people live in the past. They live in the darkness of the past. They live in the mistakes of the past. They live in the discouragement of the past. They didn't make it, and that affects them for the rest of their life, living in the past. So we don't want the future, the past to pull us back, to live in the past. And all other kinds of things that affect us. It's going to affect us to some extent, but not to the extent that we should be affected by the future. So make this note. Dreams and goals can become magnets. Dreams and goals can become magnets. And the stronger the goal, the higher the purpose, the more powerful the objective, the stronger this magnet is that pulls you that direction. Now, not only does your goals and your objectives pull you that direction, here's what they also do. They pull you through. They pull you through all kinds of down days. They pull you through a difficult time. It'll pull you through some winter of your life. Some people get lost in the confusion of the day simply because their goal is not bright enough to pull them through. One writer of ancient times said, we can walk through the valley. Even though there's shadows of death around, we walk through the valley. And here's why it's possible to walk through the valley, even though there's death and shadows and difficulties, is because we have a view of the other side of the valley. Next, it's goals that drive us to take advantage of the spring. Why would the farmer put the plow in the ground in the spring if he couldn't see the vision of the harvest when the summer is finished? Is it possible to see the finished harvest? And the answer is yes. We do that simply by faith. Key phrase, faith is the ability to see things that don't yet exist. And that's how things exist. How did this hotel get here? Someone saw it while the property was vacant. You say, well, is it possible to see this hotel when it isn't here? And the answer is yes, of course. If somebody cannot see it when it is not here, then it will never be here. So it's possible to see things that don't yet exist. Interesting. It's also a little time management quote, but let me quote it now because it goes so well with what we're talking about here. When should you start building this hotel? This is a good question for your philosophical musings. When should we start building the house? When should we start? And here's the answer. As soon as it's finished. You wouldn't start building the house until you had it Finished. If you just started laying bricks and somebody came around and said, what are you doing? I said, I'm just laying bricks. And said, what are you building? And you said, I have no idea. See, they'll take you away to a safe place. So have you got that now? It's possible to finish something before you start. In fact, it would be a bit foolish to start until you had it finished. So human beings have this remarkable ability to finish something and then start it. Okay. We've heard the old expression, don't count your chickens until they're hatched. Say, no, we have the ability to count our chickens long before they're hatched. Because we know, we have faith, we believe. We use the law of averages. There's bound to be at least so many, out of every dozen, out of every 100, out of every 50. So it's possible to see the end, then begin. So here's what we want to do in our goal setting session, is to start looking into the future of what you would like to accomplish, where you would like to go, the person you would like to be, and see if you can't get a better picture of the finished objective. See yourself there, see yourself in possession of. I was in business with Bob Cummings, the old movie star, for a while. He said, decide what you want and then act as if you already had it. And being an actor, he could give us a few tips on acting. Decide what you want and act as if it was already yours. Now, the reason we can act thinking that it's already ours is because not only can we vision the end results, we can also vision the beginning of making it real. So we don't start till it's finished, but it is possible for human beings to finish something before they start. Just jot this down. It's a bit philosophical, but we'll cover it before we take our lunch break. And that's this: human beings are the only life on earth that has this incredible capacity to change the course of your life. No other life form can do that. Every other life form except humans seems to operate simply by instinct and the genetic code. In the winter, the goose flies south. How often? Answer: every winter. If you said to the goose, hey, it'd be better this year to go west, he ignores that advice. And the reason is because he cannot make choices and listen to advice of something that might be better. He has to obey instinct and the genetic code. But now jot this down: not human beings. Human beings can alter the course of their life. Human beings can live one way for 5 years, tear up that script, live a totally different way the next 5 years. The first 6 years of my economic life, I wound up broke. The second 6 years, I wound up rich. Someone says, how did you do that? Here's number one: I discovered I was not a goose. Someone says, don't you have to do the second 6 years like you did the first 6 years? And jot this down: no. No, you don't have to live the second 6 years like the first 6. You can use all the information and all the advice and repairing all of your mistakes and adopting a new and refined philosophy so that the next 6 years can be totally different than the last 6. No other life form can do this. See, if you were a tree, you'd be stuck. As a tree, if you used up all the nourishment that was around you and you couldn't change location, see, you would die. But that's not true. Human beings can change location, go north, south, east, west, live here for a while, live somewhere else for a while. So that's a note to make. You can greatly alter the course of your life. Now here's the next note to make. 5 years from now, you will arrive. The question is, where? This is for mature people now. If you keep up your present disciplines and keep up the present pace that you're on, where will you be in 5 years? Boy, it's easy to say, hey, I haven't really thought about that. So now make this note. In 5 years, here's the probability. You will either arrive at a well-designed destination or an undesigned destination. Well-designed or undesigned. And I promise you, 5 years from now, you really don't want to arrive at an undesigned destination. Because you may very well wind up wearing what you don't want to wear, driving what you don't want to drive, living where you don't want to live, maybe doing what you don't want to do. Simply because you didn't design a better destination. Key phrase, up front, the decisions are easy. Now, sometimes after we've lived a few years now, to repair our mistakes and get back on track seems like a tough job. If you've messed up your health for 10 years, I'm telling you, it takes more than 10 days to get it back. But here's the key, and it's so exciting to talk to the teenagers. Make the note, if you start early, the fortune belongs to you. If you start early. We're going to talk later today about the fortune of the money, not just the fortune of good health, but all fortunes that are available to humans. If you start early, the promise looms large and the odds are heavy in your favor. Now, yes, it's possible to do some radical things starting late and still arrive with some good treasures and some good things. But when you haven't got that much time left, now sometimes the decision has to be so drastic, people are not willing to make it. They're too tired, too weary, and too ill. And say, look, I don't have much time left. It's not going to happen for me anyway. It's easy to take that attitude. But everyone here, we've got the time over the next 10 years. We've got the time the next 20 years. We've got the time the next 30 years to make some repair now in our errors of the past and set up some new disciplines. And I'm telling you, that's going to change everything. So, 5 years from now, I wish for you to arrive at a well-designed place. A place of productivity, a place that'll make you feel good about yourself, a place that'll give you honor and respect, a place that'll give you influence to touch other people 5 years from now that you couldn't do today. Where will you be in 5 years? Key phrase, we go the direction we face. We go the direction we face. If you start designing something at the end of this direction, sure enough, you will start going the direction you face. And we face the direction we design. Next phrase, direction determines destination. Destination is not determined by hope. It's not determined by wish. Destination is determined by direction. Now here's the good news, and then we're going to take our break for lunch. You cannot change destination overnight. You cannot change destination overnight. Which means you can't arrive at a 5 years from now place tomorrow. But here's what you can change today, and overnight, you can change direction. And it is so fascinating what a little small change of direction will do. Let's say that you're here and you're headed this way, and 5 years from now, you'll wind up here. But if you made just a few changes, and maybe those changes you've already decided on this weekend, I wish I had a chance to hear all of the stories of what's going to happen to all of you after this weekend. Right? The economic decisions you've made, the decisions you've made about your family, about your health, and about your future. I'm telling you, decision making on an occasion like this, where everybody's committed to come and learn and study and read and take notes and change and develop, it's going to be awesome what can happen after this weekend. And I wish I could track everybody's progress and enjoy all of that incredible productivity. It's going to happen for all of us. Collectively, I'm telling you, no telling how big that amount would be. But here's how we individually can arrive at a new destination. Maybe right now by discipline or lack of discipline or direction, you're headed this way. But it wouldn't take much to change direction and head this way. So that in 5 years, you wind up here instead of here. And the difference now of getting off this track and getting on this track is not much. A few decisions in discipline, a few decisions in learning, a few decisions in change of behavior, change of habit, a few decisions in setting goals that you've sort of let drift before. Like I did at age 25, didn't have a list. I immediately started to change that. And I immediately started to change my direction so that very quickly I started heading this direction. In less than 7 years, I was a millionaire. And that was just my economics. And sure enough, when I met my mentor, I was headed this way. And here's where I would have been in 5 or 6 years. Maybe okay. My kids probably wouldn't have been starving. And maybe, we got clothes to wear and a place to live. But the joy of productivity and the joy of becoming valuable to the marketplace and more valuable to my family and valuable to my friends in my inner circle, all of that probably would have escaped me if I would have kept going this way. But I am so thankful for the circumstances and whatever else arranged it for me. Some things are arranged, we don't even know how they've occurred. For you to be here, do you imagine the chain of circumstances that caused you to be able to sit in this auditorium today? It's amazing. This had to happen, and this had to happen, and this door had to close, and this door had to open. And all of those things, for me to be here, for you to be here, how come I just didn't drop out of the sky? By all kinds of turns and events, I wind up in Dallas on this June weekend, like year 2000. And you arrived here. From all kinds of directions, here we are. And so we just say, wow, part of that's a mystery, and we let it be a mystery. We don't even try to figure it out. We just say, wow, it's incredible. But now that we're here, how could we collectively and individually affect each other's lives? It's by doing just what we've done: study, learn, teach, shake hands, trade stories, and do all this stuff, so that we can help other people as well as ourselves to make that small journey to a new direction. So jot that down. It's only a small journey to a new direction. Guess how quickly you can change your health? By starting to eat an apple a day. Mama said an apple a day keeps the doctor away. Let's say you've been ill long enough, you've had health problems long enough, and you say, that's it, that's over. I'm going to now start a program. You don't have to really revolutionize your whole health life. Just start with an apple a day. You say, well, is it that simple to change your health life? And the answer is yes. The key is just to start. You pick up a book on good health, and you get halfway through the book, and it says, now, dear reader, set this book aside, fall down on the floor, and see how many push-ups you can do. And then it goes on to say, and if you have not done that, why not give this book away? It looks like you're not going to do it. Come on, you don't have to radically do something. You can gain momentum and make changes as you go. Just start. Here's what happens when you start a new direction. Self-esteem starts to accelerate. It doesn't take much for you to feel good about yourself. Just commit it to a new direction and you feel good. And an apple a day, committed to finally having a health program that'll make you the healthiest you've ever been in the next 20 years, all you got to do is munch on that first apple. And nobody even has to be around you. You don't have to announce it to the world. But you munch on that first apple and say, this is the beginning of developing a health program that's going to make me so healthy I'll have the vitality to do whatever I want to do for the next 30 years of my life. Munch, munch, happy, happy, self-esteem off the scale. Now, if you eat an apple the second day, you become almost delirious, saying, wow, I'm on my way. Somebody said, just 2 apples? Says, look, you don't understand. Not only did I do it yesterday, I've done it again today. This is really proving to myself with no audience, no microphones, no nothing, just you and yourself. You've convinced yourself, I'm on my way to the healthiest I ever have been. I'm starting a new life. This is the second day. I'm on my way. That's how easy it is to change your life. You don't need some dramatic vision. Just begin something. And maybe by health or by whatever other things we can think of to do, you just get back on a better track. Okay? It's a small journey to changing direction. And by the time we finish our workshop right after lunch, I think you're going to have a concept of how powerful it can be, not only how easy it can be, but how powerful it can be to change every part of your life.
Good evening, everyone, and welcome again to another training session of Pip Tips and Profits as we progress to get you towards a state of profitability. Right now, in tonight's session, we would be focusing on technical analysis. And with technical analysis, we'll be looking at price acceptance in ranging market, price acceptance in trending markets. We'll be looking at the types of trade execution, and we'll be looking at an introduction to risk management. Then we'll be doing some top-down analysis and also paper trading. Right. Now, as always, you can just drop a 1 if you're able to hear me. And if you're also seeing the screen, just put a 1 in the chat box and let me know. All right, so to begin, let's look at price acceptance. And this is in ranging market and trending market. Now, price acceptance is defined as any confirmed close above or below a structure in the market. This structure may be support, resistance, and trend lines. To deem a close in price as a confirmed close, then the body of the candle must be at least 10 pips above or below that structure. Confirmed close generally indicates a breakout of the structure and a continuation of the move is imminent. A failed close would pretty much tell you that a potential reversal is on the cards. All right, so these are the things we want to be looking at. So if you look at this diagram here, and we are seeing where we have a trending market, and if we, just to clarify in terms of how do we know that we have a trending market, if price was here, the market pushed higher, came back in, pushed, came again. So that's where you find that you have the trending market. Now, as the market progressed higher, we find that all this time, all downward pressure around this area was rejecting the uptrend anchor. So what you find, there was no price acceptance below this particular zone. As the market continued to push higher, the failed close beneath that area showed you a sign of reversal. And in this case, the market projected higher. As the price came back below, you find now that there was price pushing below that trend anchor, but the market did not close beneath that area. So what you find is price action below that zone or below that structure. That structure would be the uptrend anchor. Price acceptance, price action below that area, but there was no price acceptance. It took, this is our daily candle or daily chart. So we're looking at 2 days where the market pushed below, and on the 3rd day, price again pushed below that area, and then you find the close there to give you price acceptance below that zone. So now with price acceptance below that zone, we can consider the uptrend anchor to be broken and looking now for the market to start a whole new trend to the downside. Now, while this is happening here, you find price pushing back higher, fail, so you find price action below the downtrend anchor or below the broken anchor. The market attempt to push above, but failed. So we had price action above it, but no price acceptance. And a fail close above that structure would indicate what? A reversal. So that is what we're getting. Reversals coming into the market. Now, just to refresh or just to expound a bit based on what you would have already learned, is even though the uptrend anchor was broken, we do not have a confirmed downtrend as yet. So what you have now after a broken trend anchor is a high and a low. And if you identify there's an active trend that is taking place on this side, pushing back price above this support zone, but there was still no price acceptance above it because this closure here was less than 10 pips. And if because it is less than that, then now you find the market rejecting that area once more. So these are some of the things that you want to be looking at when we talk about price action and price acceptance. We have to know the difference and know when to identify it and how to read it. In this case here, here's another example where the market moved up, created a new high. So there was price acceptance above that structure, and we find price pushing higher. This is to show you now, this is the same drawing from the previous slide, same chart from the previous slide. And this was taken from live market data. So these aren't stuff that I create just for this presentation. I literally pulled it from an actual chart so that you're able to see the market in its truest form and to show you how price fluctuates around these zones. So even though you have the broken trend anchor here and price acceptance below that area push the market lower, there was not an indication that we had a downtrend in play as yet. But what we did have is another uptrend creating, which we found it here. This level being the uptrend anchor, and we can call this a minor uptrend because the overall trend was broken. So we are now looking at this minor trend to see exactly how it reacts. For this trend to continue, or for it to be considered the original or the major trend, is we would have to get price above the highs of the market. So in this case, we did not. And we found price action and price acceptance above this structure, price push higher. The market came down into the minor trend anchor, rejected. There was no price action nor price acceptance below that area, and the market rejected. Now that we found it here, also broke the minor uptrend anchor here, showing you signs of downward momentum. Now in this case, when the market broke through that level, we had an active trend taking place here. So it was at this stage that we had an active downtrend. And if we base on the active downtrend, this would become your low, this would become your potential anchor, and this level here would become your trend anchor to the downside. And as you can see, as the market progressed into that area, we found price rejecting these highs. Even though we had price acceptance above this broken structure, which would now act as support and resistance, the market still paid more respect to the confirmed trend that was taking place. So in this case, we have to know how to evaluate and how to read into what is considered to be price acceptance above an area and what to put more weight of evidence towards your overall direction. So in this instance, you would hold the trend more active, or you would put more weight towards the trend rather than putting weight towards the support and resistance area. Because here you would find the minor trend anchor, which was broken, giving you the active downtrend, But also just above that, if you follow that little purple line here, you would find that these levels were also support and resistance levels too. So you had this entire area being support and resistance. And though we had price action and price acceptance above that area, the market still hold true to the trend and we found price pushing lower. So what this is telling us is as we progress through our trading is to understand what these mean and look at them in relation to the overall market structure, that market structure being your support, your resistance, and your trends. Irrespective of what you're seeing out there in the market, whatever market structure you're looking at, whether it may be a falling wedge, a rising wedge, whatever the market structure is, it is all based around support, resistance, and trends. So if you're able to identify these systems based on the weight of evidence that you would have seen around price action and price acceptance above or below these areas, then we can start to build a case towards proper trading decisions. Now, to look at trade executions. So once you have identified all the necessary tools of your analysis in terms of your support, your resistance, your trends, price action, price acceptance, you've identified all these things. Now what? How do you actually take that trade? And that is where trade execution comes into play. And we have to look at the type of executions that we can place out there in the market. Now, what most persons tend to realize is that you're always placing 3 entries in the market, or you're placing 3 orders in the market at all times. You're placing an order for entry and you're placing 2 orders for exit every time you open a trade. And to make money in trading, we must buy at a low cost, then sell when the value increase. And in order for you to buy or sell, the broker needs to know what price is acceptable to that trader. And when we look at the financial institution or the financial market, there are really 5 ways in which you can enter a trade, but only 2 ways for you to exit that trade, right? Or let's say even by 3 ways that you can exit that trade. One being market order as well. You can exit the trade at market order, which is for any time. But when we talk about the orders that we place out there, we are really looking at only 2 exit orders. Now you have the entry would be market execution, buy stop, buy limit, sell stop, sell limit. And the exit orders would be your stop loss and your take profit. So in all, there are 6 pending orders in the market and only 1 active orders. So all these levels, the only active order that requires immediate action is market execution. This is you taking the price for whatever the next best value that the market is giving you. All these orders are pending orders. What this means is you determine the price that you enter the market, or you determine the price that you exit the market. So I can choose when to buy, whether I'm looking to buy with a stop order, I'm looking to buy with a limit order, I'm looking to sell with a stop order, or I'm looking to sell with a limit order. And my stop loss and take profit levels are also pending orders that we place in the market. Now, what's a buy stop trade order? Buy stop order is when you're looking is an order that you would place to buy a particular position in the market. But in this case, you're placing your entry above price. So what this means is that you are buying high and you will be selling higher. Right? So what this means is you will see price low in the market. In this case, let's say that you're looking for a breakout. So this is what we considered to be breakout entries. So what you're doing, you're placing your order above the current market price. So if you are seeing the market at $1.10, but you're also seeing potential for the market to go to $1.50. However, you want to get some other confirmation, whether it may be through price acceptance above this area. Let's say that $1.10 is right here. And that level being $1.10, you are looking now at the market to push higher than $1.10. So with you looking at the market to push higher than $1.10, all you're simply doing at this stage, let's pull up the drawing tool. All you're simply doing at this stage is to wait for the market to give you price acceptance above the structure. In this case, the structure would be in resistance. And $1.10 would be right here. And if you're waiting for the market to get above that area to buy, then that's what you would do. Wait for the market to give you a confirmed close above that area, and then you can buy your trade. So you're buying at a higher value than the market is currently at, but you're actually looking to sell even higher than where you're buying. So you use a stop order. It's what you use to get confirmation of price before you get into the market. What are the advantages of a buy stop order? The advantage is when you place a buy stop order rather than a pending or rather than a market execution, you're pretty much waiting for confirmation to be absolutely sure in your mind that the market is moving higher. If you place the entry here at market order and you're looking to get $1.50 and you buy at $1.10 and the market gets to $1.20 and then starts to go lower to say $1.09, then you would be losing money. With the pending order placed, let's say, at $1.15. So once the market gets above $1.10, then you have added confirmation that price is pushing higher. So you can take that value a little bit higher than the current market price, but you are getting confirmation. So you're waiting to be sure that the price is actually going higher. All right. So the disadvantage to this is you may get into the trade a little bit later. So all these orders have their pros and cons. So the pros to this would be getting confirmation out of the market, less potential of reversal, right? And the con towards this is you have a late entry in the market. You're buying at a high valuation, at a higher value than the market price. And that's really what you're looking at. But it's not to say that these orders won't be good or you won't make money based on these orders. Because to be honest with you, this is one of my favorite orders to take as well. I only take pending orders whenever I go in the market. So I'm never looking to enter a market execution. I always try to get confirmation towards my overall analysis. It's not to say that there's anything wrong with buying at market execution, because it is an order type out there. So there's nothing wrong with buying at market execution, but it's just about your own personal preference. Limit order is when you're seeing price pushing lower. Let's say that you're looking at price coming into your potential anchor. If you're in an uptrend and you're seeing price coming into your potential anchor or your trend anchor, and based on your analysis, you're anticipating that there will be no price acceptance below that area. So you're looking for a failed close beneath that particular zone, which would in turn project or indicate a reversal in the market. So you can put a limit order in place and you put a buy limit order in place. So what this means is you're buying low to sell high. This, guys, is one of my go-to orders. Most of my trades are used with limit orders. I buy low to sell high. Now, this is the biggest pro towards these trades or these type of orders, where you're getting into the market early. But what's the biggest con towards this? Price may not reverse. You could get into the trade and the market just continue to move lower. So that's a con. Price may never reverse. So there's no reversal. So that's a con towards this order type. So we now have the decision to make in terms of the type of orders that we would place in the market. Your stop loss order are always where you get out of the trade. You stop your losses. Your take profit orders are where you're looking to get out of the trade. But you're in this case, you're looking to get out with profit. So in this situation here, you're looking to see, this is now would be a sell stop order. And this is just the opposite of a buy stop. You're looking at the market coming down and you're looking for price to continue lower. So you're seeing now how these trades, or there's always two sides to every story. So you're finding now, I am placing a buy limit order at this level. But the person that is selling me this order that I am buying, they are putting a sell stop order here at that same position. So they are looking to sell low to buy lower. I am looking at buying low to sell higher. Which one of us will be correct? We don't know. So this again shows you the different type of trading decisions that is coming into the market at all time. When we look at risk management, we will start to dissect this to show you that irrespective of the decisions of what is happening in the market, place your trades. You don't know what is going to happen because the market is based around beliefs. So price in the market is a belief system. So what we do as technical traders, all we're doing is using technical analysis to aid our belief system. So our belief system, we are using technical analysis to give you a confirmation or to give you conviction to your belief. Your belief could very well be wrong. Because if the next person that is selling you here is also having a belief that the market is going lower, you are having the belief that the market is going higher. Who is ultimately going to win? It's all about the person with the stronger conviction. So if my belief system is stronger than yours, then I'm going to continue selling, keep selling lower. And I will keep selling lower until you decide that, hey, I am no longer going to stay in this trade. I'm going to get out of it. And the same is true if the market is pushing higher, because now you get in here and your belief system is telling you that price is going higher. So you keep buying and you keep buying because your belief system is telling you that price is going higher. So now we're getting deeper into understanding trading and looking at the market to show you that price in the market is really based around beliefs. It's nothing more than belief. So we can look at the price in just for what it really is. What are you willing to spend for a bag? You think about somebody with a Rolex watch and you're saying that, hey, I am not going to spend $20,000 or $30,000 on a watch, but the next person is willing to spend it. So do you think the watch price is going to keep going higher and higher and higher? It's all about what you're willing to spend on. So if I'm in a position in the market and I'm looking to sell, doesn't matter what you are offering, or doesn't matter what other signs are out there. I see a storm coming and I am going to sell because I see that storm coming. I want to get out of this business. So I just start to sell for whatever price I am getting it at. I am going to sell it. Because later down when the storm comes, everybody is going to be looking to sell. And they are now going to be looking to sell at a much lower price than where I already sell it at. So I sell now, which is already low, but when everybody else is looking to sell, I am looking to buy. So I can buy at a much lower price. So these are the thought process that goes on every single day in the market. These are the things that we look at in terms of trading. And this is how institutional traders operate in the market. Right? So in this position that we're looking at here, and we are seeing a sell limit order. This is telling us that the market, that you are seeing price pushing higher. This could very well be support, not support, but resistance. This level could also be around a trend line. Could see the trend coming in from up there. This also could become your trend anchor. Whatever the belief system that you want to put into it, it's all about what you're doing with the aid of technical analysis. That's all you're doing, using the aid of technical analysis to fuel your belief. And if we look at this now and we are saying that, okay, price is going to push back and go lower. So you're now looking to sell high, to buy lower. The person here, buyers that put you in the trade here, they have a stronger conviction that the market is going to go higher. So they are now looking to buy high, to sell higher. So you are now placing a sell limit order here, but the next person is placing what? A buy stop order in that same position. Their stronger conviction may very well push price higher, or your strong conviction may take price lower. Right? Now, I keep saying that our stronger conviction or our belief system will move the price. But ultimately, you and I are all just small pebbles or ants to the bigger picture. We do not have the spending power to really move the market. Institutions have the spending power to move the market. They're trading hundreds of billions of dollars on a daily basis. That's why the Forex market moves 7.3 trillion per day. 7 trillion. Remember now that $1 trillion is equal to 1,000 billion dollars per day that is moving through the market. So if you and I put in an order where we're at risk of losing $30, what is $30 in comparison to $100,000? Or even in comparison to $1,000 billion or 1 billion or 1 million. So if you look at the market now, we do not have the conviction or the buying power or the selling power to move the market. So what we have to look at, we have to look at what the people with the spending power are doing. What are their convictions like? And that is the art of technical analysis. So that is the reason why we must study and understand technical analysis, because we want to ensure that we are able to understand the buying and the selling power of the people who move the market, which are banks, hedge funds, insurance companies, and billionaires in the market. Now, the billionaires now, really and truly, they mainly focus on stocks. They can shift the stock market with ease, no problem. But when it comes to the finance market, or not the finance, but the currency market, you need at least 10 billionaires to really put up capital to shift the market in any one direction at any given time. But they have to be willing to inject capital. The banks are trading 100 billion per day. You have hedge funds going through 50, 60 billions per day. That's what they're trading. Every day they're injecting those type of money in the market. So when we look at the market with our $500 or our $10,000, we really aren't a concern to them at all. But it's our money that they are utilizing to profit off. So we funnel and feed their buying and spending habits. It's the same as if they have a business and you think about Louis Vuitton. They have a multi-billion-dollar company, but it's the lower and middle class people that spend the most with these companies. So we are funneling their belief system. Right? So now that we have looked at risk, not risk management, but the type of order entries, and we have touched a little bit about institutional trading and the buying power and the spending power of institutional traders and the people that really move the market. So throughout the course, you will hear me starting to refer to these institutional buyers and institutional sellers. So we have an idea of the thought process and the trading psychology that is taking place behind these large market makers, right? So in order for us to gain an edge in the market in a place where market makers are so dominant, how do we fit into that 1%? And the only way we can fit into that 1% is if we're able to apply proper risk management to our trade. This is a starting point of it. It's not the only thing, but it's a starting point of it. So we utilize technical analysis to provide the education, but we use risk management to analyze everything that we have identified through technical analysis. So risk management is the identification, evaluation, and prioritization of risk, followed by a coordinated application of resource to minimize, monitor, and control the probability. All right, so let's repeat that. Risk management is the identification, evaluation, and prioritization of risk. And it is followed by a coordinated application of resources to minimize, monitor, and to control the probability or impact of unfortunate events. Or you use it to maximize the realization of the opportunity that exists out there. So this is a core function of risk management. This is what we are looking to do in the market as traders. So every trade that we go into, we must take these steps into consideration. So when we break them down, we can break it down into 4 parts. We look at identifying risk, we assess our risk, we control the risk, and we look at the duration of the risk. Now, if you guys do when we release the start date of our next masterclass, where we will actually be going into detailed risk management and money management principles, then we will dissect these even further. But for now, and for the purpose of this course, what you need to understand is the most essential part of it in terms of identifying the risk, assessing it, control, and look at the duration. Now, when we look at identifying the risk, what's the risk that we're identifying? The Forex currency pair. So the risk may be GBP AUD. That's a risk that we have identified. When we assess the risk, we may assess to see, is pound strong? Is the Aussie dollar strong? If both currencies are strong, then you may not want to go into that at all. There's no upside for you. Because if we're trying to buy low and sell higher, which one are we going to buy? There may be no upside for us. So you want to pivot strong against weak. So that is how we now go through the process of assessing the risk. So in that assessment phase, this is where technical analysis rules through that assessment phase. And I keep saying technical analysis because that is what I am training every one of you to do. Become technical traders. We can utilize the fundamentals in terms of watching the news and all of these things. But regardless of what you do with the news or whatever the news is saying, whether it's GDP getting strong, the employment rate getting weaker, the interest rate getting down, regardless of what is happening, if we wait on those news releases before we make a trading decision, then we're already in the trade too late. Because at the end of the day, all of these news, when you identified all of these things that are happening, you get the GDP rate and you say, okay, pound is strong. When you come to the market, no, it's going to be based on price. What price are you going to look at to buy? And if you come into the market and to start to buy after the news, then you're likely to be getting in, well, not likely, you will be getting in the market at a worse value. So that is why we focus on technical analysis. Because regardless of what you want to do in terms of sentiment, analysis, whatever it is that we're doing, when we look to execute a trade, we are looking to execute that trade using price. And for us to get the best value of price, we have to know the historical data of price. Remember where and when the market was providing good value based around whatever series of events that may have happened on a worldwide basis. So we can identify potential areas where we can get the value for that money. So we are in the trade long before the news even gets released. And that's what we want to do. We want to ensure that we are in the trade before the news is released. Because if you get into your trade after the news is released, you're already in the trade too late. So we utilize technical analysis in the assessment part of the risk that we're taking. When it comes now to controlling that risk that you have identified through technical analysis, you want to make sure that the risk that you're controlling is worth the reward. So this is where we look at identifying the potential return on your investment. Surely you would not buy anything at all if you go in business and you're in the clothing business and you buy your clothes from China or you buy your clothes from anywhere at all out there. You want, or any manufacturer that you decide to buy your clothes at. Surely you're not going to buy the clothes, ship them in to wherever you are, package them, put them in your storefront, and sell it exactly for what all of that cost you. There will be no point in you doing business because there's no money to be made there. There's no upside to it for you. So if there's no upside to it for you, then it would not be worthwhile in terms of giving you a return on your investment. Right? Now, you could easily decide that you are going to So that's one way of you looking at the return on your investment. You could also buy an art piece, and you may spend $10,000 for that art piece, and you may hold on to that art piece only to get $11,000. That's you risking more than the potential return. Right? So you're down more than what you're looking to get. But at the end of the day, you're still looking at getting profit. So in the control of the risk, we're really just looking at a return on our investment. And any return on our investment, as long as we're comfortable with that return, then we can go into that trade and don't worry about it, because we are getting a comfort in terms of the money that you put down and the money that you're looking to receive. And this is why people tell you that if you put down your money in the bank in just a regular savings account, then it makes no sense, because there's nothing that is being generated there. If you put down $100 in your bank account, and when you go to withdraw it, they're going to charge you to withdraw it. So you're getting less than what you put down. So there's no return on that investment. There's a lose, or there's a loss on that investment. So these are the things that we have to look at. When we look at the duration of the risk, the duration of the risk gives us now an idea of how long we are actually going to wait for this thing to materialize, right? So that's the last stage that we look at in terms of maximizing the realization of opportunities. You realize that's the last thing that we look at. How long are we going to be holding on to this? What's the market conditions like? Can we get here next year? Can we get there in 6 months? Can we get there in just 6 weeks? Can we get there in an hour or 2 hours or a day? These are the process that we go through as a trader. So when we look at, again, GBP AUD, and we are seeing pricing resistance. So we have identified the risk, which is the currency pair. We have assessed the risk to say that the market is in resistance. Controlling the risk is to say, hey, I am going to buy at $1.80, and I am selling this because the price is in resistance. Okay, well, yeah, let's use buying. Buy stop. We're looking for the market to break out of resistance, to push higher. So we're looking to buy at $1.80. And we're looking to sell when the market gets to $2. But if the market gets back down to $1.50, then it's not worth my investment. So that's where the control of the risk comes into play. So here I look at my potential investment. If I buy at $1.80 and I'm getting out at $1.50, then my overall investment in this is 30 cents. That's a deficit that I'm willing to take, a 30-cent deficit. Now, if I'm willing to take a 30-cent deficit on this, how much money am I going to buy? Am I going to buy 10,000 units? Am I going to buy 1,000 units? What's the amount I am willing to invest? I know directly that if I buy 1,000 units, every cent that the market moves costs me 10 cents. That's it. And the market is going to move against me by 30 cents. So I am looking now to see if I can sustain this 30-cent move out of the market. 30 cents, and every time it moves by 10 cents, I'm getting this. So my overall loss here would be $3. Right? If I buy 10,000 units, what's the overall loss that I am being exposed to? And the overall loss that I'd be exposed to if I buy 10,000 units, and I'm still looking at that 30 pip, at that 30 cents or that 30 pips, because let's use the terms that we're looking at that 30 pips, then I now know that I'll be down $30. So all of this comes into the stage of controlling my risk. So let's say that I am buying 10,000 units. So I'm now exposed to $30, right? I look at the potential return on that $30. And if I sell at $2, that is simply telling me that the market has increased. Let's say that it goes here by 10 cents, the market would have increased by 200 pips. All right? And that's all I'm looking at. Or let's say the market increased by 20 pips. And I look at the potential return on my investment. If I'm okay with that return, then I take the trade. Then I can now look at, if I'm okay with it and I'm willing to take the trade, how long do I anticipate to be in this particular trade for the market to get me to that stage? And I'm going to say, based on the current movement of price, and if the average range that the market moves, let's say that the last time price was down in this level, it took 3 days to get back up there. So that's the average time that I'm looking at, 3 days. No, that's all speculation. That's just the time that you're looking at to get your return. So when you go in business and you say, in 6 months' time, I'm going to be profitable, that's a projection that you're looking at. All things goes well. But we all know that we have no control of the outcome of life. We literally have to just do what we need to do. So when we look at that, then we are able to say, okay, I am fine waiting 3 days to get my return. So all boxes have been checked. I take the trade. And that's all there is to it. And that's all you're doing. So before every trade that you go in, if you do not go through these phases, you're putting yourself at a disadvantage because you have no idea what the market condition is. So it's just like you going out there to open a supermarket, and you're going to open a supermarket in an area where you have 15 supermarkets already there. And you're saying that I am going to go there and I'm going to make money. There's no guarantee for you to make money when there's competition everywhere around you. And are you going to go there to sell? You may go there and you have to find that you have to sell cheaper than everybody else. And you selling cheaper than everybody else puts you at a disadvantage. It takes you a longer time to become profitable. Or depending on the amount that you're buying, you may very well sell cheaper than everybody else and you pull the market to you. So these are the things that you have to look at. That's you assessing your market, assessing your risk. If you don't have an idea of what your competition is doing, there's absolutely no way that you can beat your competition or you can outsmart or outplay your competition. So everything that we are doing we must take risk management into consideration. So in trading, all these steps must be followed in order to guarantee success as a trader. Technical analysis is used to identify the risk and assess the risk, while money management is used to control and stipulate the duration of the risk identified. So this is where your trading strategy it comes into play. It gives you the tools that you need to identify and assess risk. So when I provide to you at the end of this course, your trend and waves strategy, this is a strategy that we are giving to you that we have identified and assessed the risk of this strategy. The trading plan that you will get behind it will help you to control the risk and guarantee a consistent return on your investment. So you're literally getting a blueprint to being successful as a trader. All that will be left for you to do is to go out there and run your business. So this is like you going now, you decide to start a business and you decide that you're going to find somebody to do the market research for you. You're going to find a supplier. You're going to find everybody to do everything for you. All you want to do is to control the business when it starts to operate. And that's the reason why we're here. So I am literally just the facilitator of the information that you need to become successful. And I make sure that I do a proper and thorough market research to give you a well-documented presentation to identify all the risk and opportunities that will exist to you as a trader. I will give you a plan on how to mitigate yourself through that risk. And all you will be required to do is to follow through on that. And as long as you follow through on that, then you will be successful. So what will be left now is your willingness to follow through on that plan. And as long as you do your part, then we all live happily together. And that's really what it is. Right? So we are going to take a look at the charts again tonight and look at technical analysis. We're going to look at some paper trading techniques and how we can utilize just what we would have learned so far and try to execute trades around that. And then next week, when we finish up, or not next week, but in the next class, when we finish up technical analysis, then we can start to look at the psychology behind trading. But in the next session, what we would be really looking at is technical indicators, trade journaling. We'll be looking at a particular part of risk management, which is sequential trading. And then we'll also do more top-down analysis and more paper trading. So really and truly, that is what we are here to do. Right? So let's just switch slides or switch screen. All right, so here we have USD CAD already pull up, but we're going to go and work with the daily time frame. So let's just look at, and we don't want to go too far. We know that there's a lot of data that's coming in. So we're going to use only the last 2 months or about 3 months of price action. Let's go to candlestick and go to the daily time frame. Now, if we're here on the daily time frame, what are you observing based on price action here? Are we in an uptrend or are we in a downtrend? Automatically, we can see that we're already in an uptrend. Price is moving out of the lows and pushing higher. If you want to observe and analyze these levels here, and we can say these are the absolute highs out of the market. And this is a recent low out of the market. These are the pivot points that we are identifying. This is also another pivot point. And these we show you already that when we were looking at support and resistance, that all we need to do is just identify these levels, the pivot points. It shows you the more recent price acceptance levels in the market. If we look at this now as an active trend, and we push up here, that being the peak, and we are now looking to see where the potential anchor for this trend would actually exist. And the potential anchor would be right in this level. Look to the left, you would find the peak there. Come down, you would find the trend anchor here. So we now have levels to work with. We are now looking at this being our potential trend anchor, and this being your trend anchor. And I'll just highlight this in bracket to put a U to say, okay, that's the uptrend that we're looking at. So we remember what the levels are. So these are the areas now that we are looking at in terms of price. If the market continues to push lower, then we are looking for the trend to hold true to the upside when it gets down into this area. If we take this down to the 4-hour time frame, and we're assessing things here on the 4-hour time frame, and all we're doing at this stage is to highlight again important levels for us. On the 4-hour time frame, we're also in that same uptrend. When we look at the uptrend here, we find that this, let's see, that wouldn't be it. So that's not the potential anchor. So let's leave this as a support, sorry. And you'd have this level here as your potential anchor. And if you notice how I operate each and every one of these sessions, is that I try not to use specific things in terms of cherry picking anything at all to provide you with. I try to find live market data and we work through it together, because I want you guys to know that in trading, like I said in the starting part of this, is that all we're doing is trying to identify what are the belief system of large players. We can't look at our belief system, because if we believe the market is going to go higher, then that's just what we believe. Ain't nothing behind that, because we can't move the market. So we have to look at the belief system of the person that can actually move the market. What would they be thinking as the price gets around these areas? And that's all we have to try and do. And that's why we use the principles of the market to aid in that. So here we have both the trend anchor and the potential anchor roughly in the same area. So we can highlight this area to become a key 4-hour support zone. That's a level. If the market gets beneath that area, then we're automatically looking towards the daily uptrend anchor. So this now becomes our key support zone. What are we seeing out of price here now? We're looking to see how the market reacts around these areas. We can also highlight other pivot points or support and resistance levels on the 4-hour time frame. So these are the levels that we're looking at. If you look at the candlestick here, this was a doji candle that we found in the market here, followed by a bearish candle. So this is indicating to us that we should be looking at further bearish price actions out of the market. So we now identify what we are anticipating. Can we also find a trend in the market? Definitely. because we have a trend line to the downside out of the market. Do we have an active counter trend taking place? You actually do, right here. Because if you look, this was the highs of the market, and let's just draw it out so you can see it. This is the highs of the market. This is a pivot low out of price. This is pivot high. We are not going to count this low because the market needs to get below this area for us to consider it to be a trend. This little level right in here is a pivot point. This level here comes at new high, and here we're looking at that low. So we have a counter trend taking place. And what's the counter trend? If you have the prevailing trend in the market, which is the uptrend taking place, the counter trend is what we're looking at, is if you have another trend going to the downside, which is minor. So this would be retracement, rejection, or we're looking at it as a counter trend or pullbacks. So these are all the different terms that means roughly the same thing. But we only classify a pullback or a retracement as a counter trend if the requirements of a trend has been identified. And if this is the case, where we're looking at this level here being the counter trend, and we look at the market here coming out of the lows, once we have identified this level as the trend, we can actually start to look now towards where the trend anchor would be. And in that trend anchor, would we look at these levels up here? No. We would look at the most recent pivot points out of the market. That's what we want to identify. So this level here would actually be the 4-hour trend anchor to the downside. Right? So let's do that again, just to give you guys an indication of why we choose this. At this stage here, the market just created a low. So we had a high and we had a low. There was nothing active at that stage. Price retraced and the market started to move lower. Once we got beneath this low, then we can start to look at the market trending. In essence, we got beneath this low, so we have one. We're now looking for a new pivot low that's beneath this area, which we identify it as 2. And then once we got beneath this low here, we identify it as 3. So we have those 3 confirmed lows. So this is now telling us that we have an active trend in terms of a counter trend. Now within that counter trend, we are now observing to see what the pivot points in the market looks like, starting from these levels. If we can identify these pivot points, then we are also identifying key support and resistance areas in the market. And that's all we're looking at. Because here, we can observe to say that we have a trend taking place here. 1, 2, 3, 4, sorry, draw that one bad, and 5. So we can say we have those taking place there. All right, so now we can highlight this level here as a minor trend anchor to the 4-hour. Now, a key thing to look at, remember that when we're doing top-down analysis, when we go down to the 1-hour time frame where we're actually going to be looking for entry, what do we think is going to be happening there? On the 1 hour, we are likely to see a downtrend taking place in the market. That's because from the 4 hour, we're able to see this larger retracement, and this was taking place for a couple of days. So when we're on the 1 hour time frame, we're anticipating to see that downtrend taking active. Now, from that downtrend here, 1, 2, 3, you're seeing where that same minor trend anchor that we saw on the 4 hour time frame is actually what? The 1 hour downtrend anchor. So we're looking now to see what the market is going to do as it approaches this area. And if we're looking for the market to potentially hit key support, can we get a trade out of the market? And we are saying now that we're just observing price. Here, we're getting the pin bar coming out, and that pin bar is within market support on the 1 hour time frame. So the pin bar is in market support there on the 1 hour time frame. And we take a trade at the top of that pin bar, but we're looking at 4 hour resistance level right there. So you're looking at your risk here. So the potential reward there is actually less than 1 to 1. And we do not want to take a trade where our risk of loss is far greater or is greater than our potential returns. Right? So for this case, we just want to observe to see how the market reacts. So all we are seeing now is, yes, you're seeing the price moving accordingly, and we're getting those price action coming in. And now we're around the potential anchor, and the market has given you price acceptance above that potential anchor with that close. Right? However, if we look at this case here, as this was a market potential anchor, we find that even here, price already invalidated that level and push up here. So now we are looking at these areas to see exactly how the market reacts as it gets into these zones. Okay. If we look at the absolute lows out of the market, always focus on the lows of the market when you're looking at the trend, right? So this is to explain your question to say, how did I find the trend anchor? Now in this case, remember when we're finding the trend anchors, we identify the lows of the market. We look at the overall direction of the market in this case. So you want to see just from an eyeball view, is the market moving from a high to a low, or is the market moving from a low to a high? And that's what you want to look at first. Once you look at this, we're seeing that we're coming from a high to a low. So we identify now that we are in a downtrend, right? Or we're getting downward movement of price. We're not calling, and from getting downward movement of price, we can say, yes, we're in the market direction is down. To identify the trend anchor, we highlight the lows of the market. Once you identify the lows of the market, You're only concerned with the price action to the left. So even though price is all the way here, we're not really looking at this part as yet. We're identifying our location in terms of price action. And then based on what is happening in the past, we can understand what the market is now doing in the present. Right? So the first thing we want to do, highlight the lows, and then we start to observe to the left of this. So if you pull up from this stage here, we're not concerned with anything else beyond this point. So we're only concerned with stuff happening to the left of this line, because that's the lows of the market. So from that area, we identify the pivot high, which is here. So let's call that pivot 4. And let's say this low was 5. We highlight to the left of this area, we need to find pivot 3. Pivot 3 is lower, so it's here. All right, this is a pivot, so let's call this pivot 3. If this is pivot, this is also a pivot. So if that would have been pivot 2, pivot 2 must be higher than pivot 4. So we cannot count that. So we have to ignore all of these levels. Right? So because we know that pivot 2 must be higher than pivot 4, we can find pivot 2 here to look at it immediately. They say, okay, this is potentially pivot 2. So if this is potentially pivot 2, what do you really need? All you need is to find a pivot that is lower than this one. And if you find one that's lower, it would be right here. So that's 3. That's the simplest way to identify it. But once you find 3, and you have this now as 2, you just need a pivot that is lower than this. And you have it here. Right? And so this is 1. And what you're finding now is that 1 must be lower than 2, but the price action getting down into these areas. So we're looking at the impulsive price action getting down into this area. So that's what you want to look at. The impulse market coming down and then finding support to create that pivot and then the retracement that is taking place. So remember, in terms of Dow theory towards trends, is an impulse followed by the correction, then another impulse followed by another correction, then another impulse. So when you look, impulse followed by the correction, another impulse followed by the correction, another impulse. Yeah, no problem, Shannon. Right? So that's how you want to identify it. So once we have identified this now, then we can start looking to the right. Because this information will give us an explanation to what is happening here. That's what we're seeing. What is happening there. So we identify this as a potential, as a trend anchor. There was price acceptance above it, but the market immediately rejected that level and pushed lower. So now we're getting an inside bar coming into the market here. What we can say is that we're looking to enter the trade because out of the inside bar, it is giving you an imminent reversal coming in. And if we're working with the trend, the higher time frame is in an uptrend, but we have a confirmed downtrend taking place, and we are looking to get the market into this little support zone. So let us say that we are going to enter our trade right as the market get below that level. Where do we want to get out of this trade? Let's say that we are getting out if the market gets above this high, because not only if it gets above that high, it would also saying that the market would have gotten above the trend anchor too. And if it got above the trend anchor, it is telling us that there is a potential change in the market's direction. It would also mean that the market would have broken above this trend line, acting as resistance to the trend. All right, so the trend line is acting as resistance to the trend of the market. So we are here in the trend. We are looking for the market to get into the support zone, because that's what we're looking at, for the trend to remain true. And for the trend to remain true, we're looking for price to get beneath this area. So we are looking for all of these to be respected and the market to push down lower. So what are you looking at now? Looking for price to get back below these levels. So you're no longer concerned with the horizontal support levels of the market. You're more focused with what is happening on the trend. So now you execute your trade at that stage. You're risking 138 to get 491. And that's a 3.5 risk to reward. So you're risking 1 to get more 3.5. And we execute our trade. That's another pin bar coming in right in that area. Market rejecting the trend anchor. The pin bar also beside that inside bar, giving you other indications that the market is looking at reversal. Now we're getting that another pin bar followed by this strong red candle. So we're getting all of that movement coming in. And we execute our trade. Once you execute your trade, all you have to do is to give the trade time to mature. And you can observe and to do other risk management as the market progresses. But that's all you're doing. So once you are in the trade, it's all about managing yourself through that trade. All the time you're here, you're still finding the market respecting the trend line, acting as resistance. It is also respecting the trend line, the trend anchor, also acting as resistance to the downtrend. Right, so that's all we're doing. Market got above the trend line, acting as resistance. So the market would have broken above trend line resistance, but it is also respecting the trend anchor just the same. But you're in that trade. How long would you have been in that trade? This is 4 days. Let's roll this through and just keep rolling it. And in this situation, you're seeing where the market would have worked out in your favor. It's still moving. You're still in profit at this stage. Let's just continue to roll it through. And you find that the market is still holding true to that same trend line that we would have drawn. Now we're getting price coming down to this low. So that's all we're looking at. Now that even though we're getting down into these lows, we can still highlight based on the lows of the market. So let's say that you are just coming into the market now. You highlight the lows of the market here. You find this to be 4, this to be 3, and this level to be 2. So you're looking now at this level here, acting as your trend anchor. Minor trend anchor right in this level. Minor potential anchor right in this level. Because now you're getting price pushing up and pushing down against that support zone. So we're just observing things as we progress. That's all we're doing, observing things as we progress. Now the market has fallen beneath that level now, creating the new low that you wanted to see. Now, once the market has created that new low, confirming that the trend is active, we can quickly adjust everything here. To say this now becomes our potential anchor, and this level here becomes your trend anchor. So how can you manage that trade? You're still in the trade, and you're saying now that if price gets back above your trend anchor, then you're getting out of that trade. But you're now getting out of that trade with profit. So you're now in a position where it's a win-win for you. You're either going to get out at your take profit with profit, or you're getting out at your stop loss, which is also guaranteeing profits. So see, the market did not hit your take profit level, but you would have gotten out of that trade with profit. Because the market has now closed above the trend anchor here on the 1 hour time frame. And once the market has closed above the trend anchor, we can now start to look at a potential trend change. There's no active uptrend taking place as yet. We have a low here, and we have the highs there, and that's all you have. You observe price is still holding true and coming down. So we know we're now in a ranging market. So let's see if we're getting that level coming in. Now we're getting the market to create a new high. And if the market has created a new high here, we can find that we have a confirmed trend in place right at this stage here. So this is where we have that confirmed trend, right? So based on everything that we would have studied or assessed so far, you're seeing how you can utilize just regular price action, price acceptance, understanding the candlestick patterns as they appear around support and resistance areas and around the trend lines. And we utilize these to execute our trades. So in this case here, if you remember, the trade that we would have placed would have been a sell stop trade. And that trade would have materialized for you tremendously, where you would have gotten out of the trade at this stage, securing, let's see how much pips. Because we would have gotten in the trade here, and you would have secured 141 pips. The market went down, and based on how you manage your trade, which we're not at that stage as yet, but you can see where the market has moved down up to 357 pips. That's how far the market has went down. You could have put your exit point right at the trend anchor too, at the potential anchor, and you could have exited that trade with 218 pips. All of those decisions would be based on your discretion, depending on the trading style that you decide to develop. But whatever the trading style that you choose to utilize in the market, you can do this based on applying the principles of the market, which is what I am teaching you, to understand and to apply the principles of the market. And then once you understand and you're able to apply the market principles, then anything else that you do or add towards it, it's just amplification of what you have already learned and understand based on the principles. So you want to add Fibonacci to it? Sure, you can add it. You want to add moving averages to it? Sure, you can add it. You want to add pitchfork or all these other technical terms that are out there, all these things that are out there are built up based on everything that is taking place here. Price action. So that is what you want to do. Understand the movement and the reasons behind price, right? So this is the core concept around technical analysis and also trading in terms of how you assess your trades. And in this case here, the market worked out in our favor quite nicely. You won't find situations where it happens like that to you all the time. Now, in the next class, when we start to look at sequential trading, we will see just how we can understand and apply how we truly make money. Is 2 and 4 always a trend anchor and potential anchor, no matter where they fall? Yes. Because what you find, it's not, I label it as 2 and 4 to give you an understanding of identifying these areas easily, right? But what you have to remember is the basis upon which the trend is created. Now, what is considered to be a trending market is, let's say that this is your graph here, and you buy something at ground zero. And there was a peak in your season where this became the highest point that persons were willing to buy your product, and the market started to fall. But because it is a good product and it's still in early days, more people at this stage, what you're finding here is taking place is the early investors, right? And this is how trends take place. You share your idea with your friend or your family or an investor, and they're pumping money into your idea. They're pumping money into your idea. And as they're pumping money into your idea, you're starting to become more recognizable to the other public or to the market, right? So people start to see you. Eyeballs start to roll out and start to look at you. More persons are looking to buy at this stage. However, the psychology behind the market is that if people are looking to buy here, who would be able to sell them? You would have to sell them. And you're selling, which simply means that during your selling stage, you're actually taking profit. So that's why you find the market start to move, come back down, profit taking. But buyers are coming in here because it's the buyers that are coming in at that stage. They're seeing the movement. They don't want to miss out. And they're coming into the market now. Buying taking place all the way down here. Once you're comfortable taking profit, and you're buying. And the more that you're selling, you see the price falling. You decide that, hey, I'm not going to sell anymore. I'm going to stop. The minute that you stop selling, here, there's nobody else willing to sell any lower than this, because everybody that was buying coming down here, they are waiting for the market to get back higher in order for them to make a profit. So they are now actually looking to sell at these levels. You were the only seller in these stages, and you stop selling at this stage because you are comfortable with the profit that you would have earned. So these buyers in here, they now need to sell. So what you're seeing now is all the other people who are here still seeing everything happening as good potential. They now start to look to buy. They are now buying from these people who are looking to take profit. So you find that the market push higher too. And as these persons, these new buyers coming into the market, provides these second stage buyers. So these are the first buyers coming into the market, right? These is where you stop to take profit at 2. The next set of buyers coming in, which would be the third set of buyers. Because here you have your investors coming in. But your investors don't really count like that. They move the market. So we call these now the third set of buyers coming in. As these new buyers start to take profit, the market repeats its process. They are comfortable taking profit, but they realize now that price is still having the potential to get higher. But they also see the fall in price they endured here. Market push higher. Now it's coming down. Second time, they're saying, hold on, I may be in profit here, but that's good. But this is the little level here. Now that I've seen the market pushing higher, here, all these buyers that came in, they are looking to take profit at these levels. But you have new buyers looking in the market here. Now, these people up here are the buyers who waited to see all of these movement happening. And they're saying, hold on, it looks like something is really happening here. So let me get in. But at this stage now, you have you, the investor down here, who started the company. You have your investors who and friends and family coming in here. You have the first set of buyers. You have the second set of buyers coming in. So you have 4 sets of buyers coming into the market now, looking to sell. They know, everybody now looking to take profit. As you're seeing 3 peaking, 3 times the market arise, 2 times fall. See? So what you're finding now is that these people are trying to get out in terms of profit. They don't have much profit to take because they're now coming in. This is fear of missing out starting to take place in the market because they don't want to miss out on the opportunity. But that's why you find that this last move is generally small. And they now start to sell. These people buying, but you find sellers coming in here. The market start to sell off and the price continues to sell. So you find these people now become the losers. They now start to sell too because they came into the market hoping for price to get higher. And price didn't get higher. So they thought no, that rotted. They came into the market at a late time. So they are now starting to get out. So they become sellers too. They now become sellers at a loss. The fear of losing money start to kick in. So they now trying to get out because they weren't confident in it to begin with. So they are now coming out. So there are no profit takers starting to sell. These persons start to sell. You, the investor, trying to take profit too. So you find that the market continues to get lower. So the concept behind it is that you want to understand that when you find the market moving in 3 stages, 3 drives out of the market, the second drive is the potential anchor. This is where you're looking at the first sign to say that the market may actually change its direction. So that's all you want to look for. Impulse, correction, impulse. So I just label it so it's easier for you guys to understand. So I said the first impulse, label that 1. First correction, label that 2. Third impulse, label that 3. Fourth impulse, correction, or the second correction, label that 4. Third impulse, label that 5. So you're looking now at the 4th correction. Now what is actually taking place here is this is resistance, which would be acting as support to the market coming down. This is also support acting, holding up price to get it back higher. So that's why you have this area being the potential anchor, because the market would have broken through support here. This is now the next support that you're looking to hold it. If the market break through that level, this would be the next support that you're looking to hold price higher. And if market break through that level, you're looking at 4 support that the market would have pierced. 1, 2, 3. This now becoming the 4th one that you're looking at the market to hold through. So if the market pierced through that level too, what you're seeing is a strong movement of price going the other way. There's clearly a sell-off that is taking place. Do you want to stand up in front of a moving train? No, you don't. So that's why you're trying to get out at this stage, because the market would have created 4 levels going up and you got rid of them coming back down. So the only place that is left is for the market to come back to ground zero. So this is where the trend changes. So that's really the application behind it in terms of understanding the overall trend. So what I want you to focus on is not to try to identify, say, 1, 2, 3, or 4, but to look for the pivot highs of the market. You look to the left to find a pivot low. Then you look to the left of that to find a pivot high. You look to the left of that to find a pivot low. And you look to the left of that to find a pivot high. So you get 1, 2, 3, 4, 5. And that's all you want to do. Identify the drives out of the market. All right? So that's really what you're looking to do. So it doesn't matter where they may want to fall in the market. You're looking at the price action and the psychology and the thought process behind institutional buying power. So that's really what you want to identify, right? So don't try to locate to say, okay, then this is 4 or this is 2. Just identify them as the pivot lows, pivot highs, and just know what you're looking for, right? And each one must be higher than the next one. So for the highs of the market, you need to find ones that are higher. And for the pivot, in terms of the anchors, we're looking to find them a little bit lower. All right? So all you have to do is just keep practicing, and it will come over time, right? So once you practice, just remember the principle in terms of how it is derived. I would also recommend just to re-watch this particular video so you can observe to see them, or you watch the previous sessions to see exactly how we construct them. So all you're trying to do is to locate the principles behind them. All right? So we leave this here for tonight, and come Thursday, like I said, we would be looking at sequence trading we'll be looking at a few technical indicators, the Fibonacci and the exponential moving average. We'll be looking at how you can journal your trade, the risk management principles that takes place, and we'll be looking at top-down analysis and paper trading. And this would actually conclude technical analysis, because after this stage, everything that you're doing is based around the foundations upon what we would have set already, right? So we would have completed the technical analysis aspect of trading. It's only to practice everything that you would have learned so far. So start the practicing from now, right? So when we start apply indicators to these things, which is really just to aid your decision based on what is happening on the chart, right? So we are able to make a better decision or to make a more educated decision in terms of what the institutional traders are thinking. And from there, we can look to increase our probability of trading successfully. And then we can apply risk management and sequence trading towards this process to ensure that we remain profitable and we are able to make money consistently. And that's really the aim of what we are trying to accomplish. Consistently making profits, right? So once we have completed that, then next week we can start to look at the trading strategy, which is the trend and wave strategy, to showcase how we follow the trends and the wave patterns of the market to try to capitalize on the big moves of the market. Because the markets are always trending all the time. You may hear that the markets only trend 30% of the time, but I want to tell you that there's always a trend that is active in the market. There's always a trend that is active. And that's what we're trying to do. Find that trend and trade in that trend. Okay? So that's really what we're looking at. And that's what the basis of the trend and wave strategy is around. So we will take a look at that next week when we conclude technical analysis and so forth. So here, all I would want you to do, just to keep practicing what you would have learned. Revisit these videos if you need to, right? And ask questions in the group, right? So you can just send me a message. Next week, I'll give you a few assignments in terms of the trades that I would love to see analyzed and to give me identification of particular things in terms of what we'll be looking at and so forth. All right. So we leave it there for tonight. If you have any questions, you can just post them in the group and we'll have a discussion on that. All right. So good night and thanks again for tuning in. See you Thursday.